Welcome to the ninth episode of Talks with Daulat. My name is Akshita Maheshwari, and I am the content and growth lead here at Daulat. Today we have with us Varun Fatehpuria, the founder and CEO of Daulat. Daulat is a tech-enabled, all-in-one solution for Indians to invest better and reach their financial goals. Before Daulat, Varun worked with some of the biggest investment institutions in the world, like Bloomberg and Blackstone. He also graduated with distinction in finance and information systems from Hong Kong University of Science and Technology. He is also a NSIM certified investment advisor. We are glad to have you here with us, Varun.
Thank you so much for having me once again, Akshita, today. And I'm really looking forward to this episode because this is a topic which is really close to my heart.
Yeah, I'm looking forward to it too. So, to all the viewers and listeners, today we are going to discuss about regular and direct mutual fund plans. What's the difference between them, and how do you choose which one is suitable for you? But before getting into that, Varun, could you please explain us what is meant by expense ratio?
So before we understand what are the various plans which are offered by the mutual fund companies to individual investors in India today, it is really critical to understand the concept of what an expense ratio or a total expense ratio, which is charged by a lot of these mutual fund companies, right? So effectively, what a mutual fund is, what it does is it effectively pools money from investors like you and me, assigns a professional fund manager who then decides when and where to invest that money, right? That is broadly how a mutual fund at a very high level structures. So obviously, to be able to provide a lot of these services to investors all across the country, mutual fund companies incurs a lot of expenses on a day-to-day basis to be able to run their operations. This just not only includes the salaries that it pays to the professional fund managers and the research analysts for analyzing the stocks and bonds, but also various other expenses, for example, paying brokerage charges to the broking companies every time it buys and sells a stock, paying a certain amount of fees to registrar and transfer agents, payment gateway providers, clearing corporations for actually keeping a record and managing the transactions, and also a certain amount of commission that it pays to various distributors all across the country, whether that's an independent financial advisor, a wealth manager like Dollar, to be able to bring mutual fund as a product in front of investors all over India. All of these expenses are clubbed under a single head called as an expense ratio or a TER, a total expense ratio, which is charged as a percentage of the overall money which a mutual fund company manages. So let me explain that to you with an example. Let's say a mutual fund company manages 100 crores of total money for investors all across the country, and it charges an expense ratio of 1%. What that means is 1% of 100 crores or approximately 1 crore is allocated towards the various expenses that is incurred by the mutual fund companies on a day-to-day basis. So that includes all of the salaries and the payments and the fees and the expenses that it incurs. And the balance, 99 crores of money, is actually used in buying and selling stocks, right? That is broadly how a expense ratio functions. At an individual investor level, when you're investing in a mutual fund, since you are investing in a unit of a mutual fund and you are allotted a NAV or a net asset value against those units, this expense ratio is also then proportionately deducted from the NAV to be able to provide you an accurate representation of the holding of your overall money in the mutual fund. That is what a total expense ratio is. It includes the various expenses that the mutual fund company incurs on a day-to-day basis for running the operations.
Understood. So, can you tell us about the different plans that mutual fund companies offer to the investors?
So now that we have an understanding of the total expense ratio, let's understand what are the plans which are offered by the mutual fund companies. In India, currently, there are two plans which are offered. One is called a direct plan and the other called a regular plan. Direct plan is something which was only introduced by the regulator, by the Securities and Exchange Board of India in 2013. And prior to that, there was only the regular plan. What the direct plan is effectively telling you is if you invest in a mutual fund directly with the fund houses or the AMCs without going through any sort of a distributor or a wealth manager, you are in a sense if investing in a direct plan of a mutual fund, because the mutual fund companies now does not need to pay any sort of a commission or the sales charges to the distributors. On the other hand, when you are investing in a regular plan of a mutual fund, you are in a sense effectively investing through a distributor, through a wealth manager, whether that's an independent financial advisor, a wealth firm, a bank, through a regular plan of a mutual fund, because now the mutual fund companies need to account for the sales commission, the commission charges that it needs to pay to these distributors for bringing this product to the masses. Where it differs is in the form of the expense ratio that we are just going to talk about, how the two plans of a mutual fund differs.
Okay. Are there any similarities between these two plans?
So effectively, everything, whether you invest in a direct plan of a mutual fund or a regular plan of a mutual fund, remains the same. The underlying portfolio, the underlying fund manager, the underlying strategy, everything virtually is the same. So it is not that if you're investing in a direct plan and you're missing out on something, or if you're investing in a regular plan, the strategy is completely different. Nothing like that. The only where it actually differs is in the expense ratio, which we talked about, since the mutual fund companies now do not need to account for the commissions that it is paying to the distributors, the direct plan of mutual funds obviously has a slightly lower total expense ratio. And on the other hand, the regular plan of a mutual fund tends to have a slightly higher total expense ratio because it includes the commissions that is paid out by the mutual fund companies to the various distributors. That is where I would say the differences, and the only difference between the two plans remains in the total expense ratio and where you purchase it. So obviously, if you're investing in a direct plan, you're buying it directly from the mutual fund companies, or a lot of the discount brokerages today, let's say, for example, a Grow or a Zerodha, all of them offer a direct plan of mutual fund. But when you're investing through a professional, when you're investing through a wealth manager, then in essence, you are investing in a regular plan of a mutual fund because it needs to account for the commissions that it pays, that it is paid for by the mutual fund company.
Got it. Now that we've understood the similarities and differences between these two plans, how do I, as an investor, decide which is more suitable for me?
So I'm sure a lot of you would have, at least a lot of the investors who got started in the markets in the last 2 to 3 years would have read or seen or heard somewhere that you are missing out on a lot of gains if you are actually investing in the regular plan, right? They make it sound like that you are probably doing a grave mistake by investing in the regular plan of a mutual fund, but that is not really the case. It's a bit more nuanced, and you need to understand without getting into the trap of the lot of the financial influencers and these apps who have naturally the tendency to hype up some things, right? So if you are a day-to-day normal investor who do not have the time and the knowledge and the resources to track the market, to keep a track of what's going on in the mutual fund space, then obviously it is always advised for you to invest in a regular plan of a mutual fund through a professional distributor or an advisor or a wealth manager. What these companies will effectively do for you is understand your risk profile, understand your time horizon for investing, and then suggest you suitable schemes, right? Today in India, there are approximately 8,000 different mutual fund schemes offered by 45 different mutual fund companies across 25 or 30 different fund categories. As an investor, it is very easy for you to get lost and get, I would say, sideways if you do not have an understanding of how these things work. How do you keep a track of your portfolio? How do you rebalance it pretty much on a quarterly or a semi-annually basis? So if you do not have the time and the knowledge and the bandwidth to be able to pass through a lot of the information, it is always advised for you to get started with investing in a regular plan of a mutual fund through a trusted advisor. Now, the word trusted over here is very important because, yes, there will always be bad players who will suggest you schemes which will pay them the highest commission. But I think anyone who's serious about their business, anyone who's serious about building a long term distribution business, will always recommend schemes, will always recommend funds which are in the best interest of the investor. On the other hand, if you think you have gained a sufficient amount of experience and knowledge through a period of time, then the direct plan for you is advisable, because now you have the time and the knowledge to be able to do this. But just to keep in mind, doing all of these things actually take a lot of time. And we have seen a lot of young people, especially people who are just getting started with investing, to think that this is something that can be easily done. This is easy money. And by just clicking a few buttons here and there, they'll be able to reach their financial goals. But again, I would say experience and time has shown that in times of volatility, in times when the markets actually come crashing down, it is the direct plan of investors. It is these DIY investors who are the first to actually seek exit, right? So to give you some statistics, in India, roughly 80% of investments are still done through the regular plans, right? And a very interesting statistic had come up a couple of months ago, rather, where it's shown that approximately 32% of the investors who had invested in the regular plan actually stay invested for a period of 2 or more years. If you switch to direct plan, you see that number come down to approximately 14%, which basically shows the trading mindset which a lot of the people have, right? They try to make sense of a lot of news which is being thrown at them and think that they'll be able to, accurately time the market, which is not the case. So try and understand firstly your own individual, I would say, risk tolerance. Try and understand whether this is something for you. And if you think you do not have the time and the knowledge and the bandwidth to be able to do this full time, because it's pretty much a full time job to be able to track the market and to create suitable investment portfolios, get started with investing in a regular plan, understand that space, maybe stay invested for a few years, 5 years, 7 years, 10 years. Once you get an understanding, right, and if you then think that you will still be able to do it by yourself, then you can get started after that by investing in a direct plan of a mutual fund. So that is how I would say the direct plan and a regular plan of a mutual fund company is, and how you should be thinking about as an individual investor.
All right. Thank you so much, Varun. This was indeed a very insightful session. And I hope that our viewers and listeners also really enjoyed this. I'll see you again next week.
Thank you so much, Akshita, once again.